This recording is going to explain the two fundamental accounting equations and then also kind of refer to the statement of cash flow and how to deal with that. So this applies to chapter 3 of our textbook, and it's all been cumulative to this point. So the real foundational and the real meaningful accounting equation is that assets equal liabilities plus stockholders' equity. In real basic terms, assets are things that the company owns, although the formal definition will refer to it as economic resources of the company. But basically, think of it as something the company owns. Liabilities are the debt or the economic obligations of a company. So that's dollar amounts that the company owes to others. And the last component is stockholders' equity, and it's often referred to as what's left over, the residual. And think of stockholders' equity. In this course, we're studying corporations, so the owners of a corporation are the stockholders or the shareholders, meaning the same thing. So this is what's left over that belongs to the shareholders or stockholders, whichever one you want to call them. Of stockholders' equity, there's really two components of stockholders' equity. One represents the stock that was issued to the investors or the shareholders. So the transaction that creates common stock is when we issue or sell it, right? Common stock account's going to go up, and we'll go over here, and the cash account and assets will go up. Retained earnings. Profits belong to the owners. That's why it's a component of stockholders' equity. So earnings could be called net income, could be called profit. They all are the same thing. That belongs to the owners. And if we're keeping or retaining those earnings in the business, then it's going to stay in this account, retained earnings. Well, what are earnings or net income? Well, net income is revenues minus expenses. And revenues are basically when we sell goods and services. And actually, it's when we deliver or provide those goods and services. And then expenses are when we consume a cost. So it could be we consume an asset, we consume or use up an expense. And the difference between these two is our net income. Obviously, these two things comprise the income statement, the first financial statement that we prepare. The third item that impacts retained earnings is dividends, because dividends are when we distribute earnings. It's a distribution of earnings. So when we give the earnings back to the shareholders, that's a dividend. And yes, retained earnings will go down. We also over here under assets would have to have the cash to pay for that dividend. Okay, so that's the first accounting equation. And so in chapter 1 and 2, you learned how to always keep this equation in balance. So like down here, if assets go up, then something on the other side, liabilities, common stock, or these accounts under retained earnings also had to go up. And by the way, I should make a note, in order to get this all on one sheet, I put the revenue and expenses here under retained earnings. I understand that your author put them over to the side, had a column for revenue and a column for expenses, but just to get it all on one page, I listed them here. So if this side goes up, this side also has to go up. And if this side if assets go down, something on the other side has to go down as well. So that leads us to, in chapter 3, our debit credit rules. The debit credit rules are just rules to quickly process transactions. They don't really have any meaning behind them. There's certainly meaning in our primary accounting equation, but the assets equal liabilities plus stockholders' equity, but debit credit rules are just a way to quickly process transactions. And by the way, these two accounting equations will simultaneously stay in balance. That's why, the whole idea of these accounting equations staying in balance at the same time It was really a mathematical genius that came up with this idea. So the debit credit rules, you've already gone through this in chapter 2. If one side goes up, the other side has to go up. And so we're just going to call, if assets go up, we're going to label that a debit. And if the other side goes up, we're going to label that a credit. And then again, if assets go down, the other side has to go down. If an asset goes down, we're going to call that a credit. And if the other side goes down, we'll call it a debit. Now, remember or recall from chapter 2, assets can go up and down. So it's possible to have a transaction where I have a debit to an asset and a credit to an asset. And likewise, the same thing on the other side. Something could go up, at the same time something goes down, and that's going to be the debit and credit. Applying the debit credit rules to retained earnings, then applying it to these components of retained earnings. So credits are something that cause retained earnings to go up. I'm just going to abbreviate CR. So revenues will have credit balances. Anything that causes retained earnings to go down will have debit balances. And I don't know why, but the abbreviation for debit is DR, debit. So revenues are credits, expenses and dividends are debits. And of course then common stock, issuing the stock is a credit as well because it causes it to go up. The last thing I want to talk about while I'm here is the statement of cash flow. So we know under assets, cash is one of our assets. There's other ones, right? Like accounts receivable, supplies, buildings, land, all of that. All of those various things are assets. The statement of cash flow, though, particularly pertains to our cash account. And by the way, when we see cash in the accounting records, it usually represents the checking account in the bank. It can include physical cash on hand, but the large component of cash is really the dollar amount in our checking account. Okay, so we're going to look at the flow of cash, right? Cash flows in, cash flows out, just like it flows in your checking account and flows out of your checking account or your bank account. It flows into your bank account, it flows out of your bank account. Or maybe it flows into your wallet and then out of your wallet, wherever you keep your money. So money will come in, money gets spent and goes out. There are 3 categories of cash flow: operating, financing, and investing. I'm going to start with the financing activities, then I'll do investing, and then I'll talk about operating. Financing activities are called financing activities. If you look at our primary accounting equation, assets equal liabilities plus stockholders' equity. When a business first gets started, it will always finance any of the assets it's buying by either borrowing money or issuing stock. So that's why the financing activity has to do with long-term liabilities and stockholders' equity. That's how we often finance our assets. Now, once we've been in business a while, yes, often there is cash in the bank we can use to buy some of our assets, or at least part of those assets. But until we have enough money earned, collected, we finance with debt and equity. So you can see cash coming in when I borrow money, or cash paid to reduce that loan is a financing activity, or cash from issuing stock, or cash paid for dividends, that's a financing activity. Then investing activities investing is not what you and I want to think of, buying stocks and bonds. Well, by the way, it certainly includes that for a business, buying stocks and bonds. But it's more than that. It really will have to do with these long-term assets. buying these long-term assets. So cash paid to purchase a long-term asset like buildings and land. So the business is investing in itself. Buildings and land, which are primarily we have to do whatever it is we're in business for. Now, once in a great while, we will maybe have a parcel of land and sell it. But we're not in the assuming we're not in the business of selling that land, then the cash received from selling that long-term asset is an investing activity. Okay, then operating activities that get listed first on the statement of cash flow are really from our primary operations of the business, selling goods and services, and then the cost incurred to generate that revenue, which we call expenses. So it's when we get the cash from revenue type activities or when we pay cash for expense type activities. And in Chapter 3, we are learning that the cash may be received before we earn our revenue. We might collect the cash from the customer right when we deliver the product, or we might receive the cash after we deliver the product. So the cash may or may not be received at the time we earn the revenue. Same thing with expenses. We could prepay for expenses like rent is typically prepaid, paid in advance. We can pay for expenses as they occur, like usually that would be salaries. Or we can pay for expenses after we have used them. Utilities is a good example of that, right? You use utilities, and then at the end of the month, you get a bill from the utility company to pay for something you've already consumed. So again, the payment for the expense isn't necessarily when I record the expense. This is the cash paid for that.